Tilray Brands, NASDAQ, TLRY, currently trades at 1.38, reflecting a difficult day with a decline of over 6% from its previous close. This price point sits in the lower end of its recent trading range, a dramatic shift from its 52-week high of 1.88 and even further from the speculative highs of its past. The immediate, surface-level narrative is one of a beleaguered cannabis company, still struggling to find its footing amid a challenging market. But that's where the common narrative ends and the true story begins. The real tension isn't just about market headwinds. It's about a deep, fundamental shift in the company's DNA, one that most retail investors are still missing. The expectation is that Tilray is simply a cannabis company, a play on U.S. legalization, and a bet on a maturing recreational market. The reality, however, is that Tilray has been quietly yet aggressively transforming itself into a global consumer packaged goods (CPG) conglomerate, with its future growth anchored not in cannabis, but in an unexpected and rapidly expanding beverage alcohol empire. This pivot is the central, misunderstood thesis that creates the stark divide between its volatile stock performance and its underlying strategic evolution. The market narrative for Tilray has long been dominated by the on-again, off-again hope for federal cannabis legalization in the United States. Every whisper of a policy change, every piece of legislation, sends the stock on a roller coaster ride. Just recently, speculation around potential rescheduling of cannabis by the U.S. government provided a temporary lift, but as quickly as it rose, it fell back to earth. This is a classic example of a stock priced on future potential, not current performance. But while investors fixate on Washington, D.C., Tilray's management has been executing a far more tangible and immediate strategy. Their massive acquisition spree, particularly in the craft brewing sector, is not a side project. It is the cornerstone of their new identity. This is the first major point of divergence from the common view. The company has methodically acquired iconic American craft breweries like Sweetwater, Montauk Brewing, and a host of others from Anheuser-Busch and Molson Coors. This wasn't just about adding revenue. It was about building an entirely new, diversified, and most importantly profitable business segment. In their most recent quarterly report, the beverage alcohol division saw a notable increase in sales, with gross margin expansion to boot. This isn't just a pivot, it's a strategic de-risking of their entire business model. By building a robust, cash-flowing beverage business, Tilray is creating a financial foundation that is less reliant on the volatile and often unprofitable cannabis market. This is the engine that is designed to fund their future growth, even if federal legalization never comes to pass. The financial health of the company, when viewed through this new lens, also tells a different story. The common narrative points to a history of large net losses, including a staggering $793.5 million net loss in a recent quarter due to a non-cash impairment charge. This headline number is certainly a red flag for any traditional investor. However, a deeper dive into their balance sheet reveals a more nuanced picture. While the company has taken significant hits from asset write-downs, which reflect the harsh realities of the cannabis market's overvaluation in previous years, they have also been actively reducing their debt levels. With a debt-to-equity ratio that has been improving and a decent cash position, the company is in a more stable financial position than the headline losses suggest. The non-cash impairment charge, while massive, is a one-time accounting event that cleans up the balance sheet from past missteps and overpayments. It's a bitter pill to swallow, but it's a sign of management addressing past issues head-on. The more important metric for a growth story like this is not the non-cash loss, but the cash flow and operational performance. Tilray's focus on improving gross margins across all its business segments, including the beverage and wellness divisions, shows a concerted effort to move towards sustained profitability. They are no longer simply chasing top-line revenue at any cost. They are implementing strategic initiatives aimed at enhancing margins and long-term operational efficiencies. This shift in focus is a critical yet often overlooked part of the story. This brings us to the second and perhaps most potent insight. Tilray's aggressive international strategy is far more significant than its North American struggles. While the U.S. market remains a tantalizing but unpredictable dream, Tilray has been systematically building a formidable presence in global medical cannabis markets. Countries in Europe, particularly Germany, are leading the charge in medical cannabis adoption. Tilray has positioned itself as a key player in this evolving landscape, with its EU GMP-certified products and strategic partnerships. Their medical cannabis sales in Germany have shown significant growth post-legalization, with flower sales soaring. This international play is a critical part of their long-term growth story. Unlike the fragmented and often oversupplied Canadian and American recreational markets, the European medical market offers higher margins and a more stable, regulated environment. The company's strategic decision to redirect inventories to these high-margin international markets is a brilliant, underappreciated move. It signifies a mature company's decision to prioritize profitable growth over revenue at all costs. While U.S. retail investors are waiting for a binary event that may or may not happen, Tilray is already building a defensible, profitable business in a global market that is already here. This is a classic reality exceeding expectation moment. The expectation is that Tilray's fate is tied to the U.S. The reality is that they are quietly becoming a global cannabis leader, one that is not dependent on the whims of a single country's political process. The final element to consider is the nuanced relationship between Tilray's various business units. The company isn't just a collection of disparate businesses, it's an ecosystem. The beverage acquisitions, far from being a random assortment of brands, create a robust distribution network that can one day be leveraged for cannabis-infused beverages in the U.S. should federal laws permit. This is the long-game thesis that connects all the dots. The company is building the infrastructure, the brand portfolio, and the consumer relationships now, so that when the regulatory tide finally turns, they will be uniquely positioned to dominate. This is a much more intelligent and strategic approach than simply waiting for a legislative change. By acquiring established brands with existing distribution channels and loyal customer bases, Tilray is not just buying revenue, they are buying market access and a playbook for navigating the complex U.S. market. The strategic value of this is immense and far outweighs the short-term financial volatility. The recent moves to consolidate and streamline their operations, including SKU rationalization in the beverage segment, further reinforce this commitment to profitability and long-term efficiency. They are trimming the fat and focusing on their most promising products, both in cannabis and in beverages, which is a sign of a mature and disciplined management team. In essence, Tilray is an exercise in delayed gratification. The immediate data points the volatile stock price. The headline losses suggest a company in distress, but the underlying strategic moves, the diversification, the international expansion, the debt reduction, paint a picture of a company building a new, more resilient foundation for future growth. The real question for investors is whether they can look past the surface-level noise and recognize the silent transformation that is already well underway. Tilray is no longer just a cannabis stock. It is a complex, multifaceted CPG company that is betting on a future where its diversified portfolio of brands, both alcoholic and non-alcoholic, will drive sustained value regardless of the pace of political change.